Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have David McAlvany with me once again. He is the president of the McAlvany Financial Companies, McAlvany Wealth Management, and ICA. It's a precious metals firm that can help you protect your investments, including gold, and in your IRA. And you can easily access the ICA website by going to my website at jtaylormedia.com, clicking on the ICA banner up towards the top on the left-hand side. It will get you right to ICA. I should mention that I had the pleasure of meeting David in person for the first time here in Queens, New York City, last week when he spoke to a group of investors. His message was, of course, largely familiar to me and to a lot of the listeners, well, all of our listeners, I presume, in this show, as a believer in gold. But it's a message that people need to hear to prepare for what are likely to be some very difficult times ahead. Life, sometimes we sail through and things seem fairly easy, and then sometimes things can get very difficult. We've had quite a few years here now, financially speaking, where times have been pretty easy from 2009 on till about now, one of the longest stock market bulls that we've had in our history, if not the longest. But things may be getting a little rocky ahead of us, so we want to be prepared for that. So I want to thank you, David, for joining me again today.
Jay, great to be with you again.
It's always good to have you. I think before we get started on a discussion of the markets and related topics, can you take a minute to explain one of the companies under the McAlvany umbrella, that is ICA, that I just referred to, what it has to offer, and then perhaps also outline how beneficial gold can be used in general in a portfolio to enhance returns and reduce risk?
Yeah, we've been in the metals business since 1972. My dad was involved with just a few other guys in helping get gold legalized January 1st, 1975. So it's a privilege that we can take for granted today. But from 1933 up until January 1st, 1975, it was illegal. We found a workaround, and so we're in business and had sort of a first mover advantage in the bullion space starting in 72. The business is very well capitalized. It has an amazing staff, and average tenure in the business with the folks that work with us, 25 years plus.
Wow!
The average. We've got a few in the 36 to 38 range, and
that's unheard of.
Wondering if they'll ever retire, but they love what they do, and we love them being here. So we help folks with precious metals. It's one of the aspects that we do. IRAs. We were the first company to put physical metals into an IRA when the rules changed back in the mid-'80s. And so creating innovations within the space is kind of how we started and how we continue to make our mark. Love long-term relationships and adding value through all the things we do.
Okay, so owning gold in your IRA is one of the things you can do at ICA. So
yeah, and all the other precious metals too. Of course, silver and the platinum group metals. And whenever one looks more attractive than the other, we're able to help with the advice and the advisory side of that, so that someone knows what to do, when to do it. And I think one of the things that also sets us apart is we have a reduction strategy, an exit strategy, as and when gold does incredibly well, we kind of know where to go next. And everyone else in the gold space, I think, to me, feels like pay less shoes. You walk in, you buy a pair of shoes, and they never want to see you again. For us, we develop long-term relationships, advisory relationships, and have an exit strategy as well. So, again, I think we're just engaged in a different way.
David, I'm just thinking in an IRA, then probably you can switch from, let's say, when it makes sense to, when silver, as it is now, very undervalued relative to gold, you could sell some of your gold and buy some silver and not worry about a tax event, I suppose, in an IRA, right? Because, it would be just like my IRA in the stock market. I can buy and sell things, and I don't have to worry about taxes until I pull the money out of my IRA.
That's exactly right. So the gold-silver ratio is something that we've very, very effectively traded for the last 48 years. Platinum and palladium as well. The last time we moved from palladium back to platinum, we increased ounces by 350%. So we're if you're looking for a strategy and not a static portfolio, then working with someone who's got the experience in that advisor role, I don't think you'll find anybody more certainly we've got a lot of years in it. So love to help if we can.
More experienced and well capitalized, and love what you do. Those are all attributes I think that I would want to see in someone that was managing my money. Maybe just briefly, David, very briefly, because I know we're going to run out of time real fast here. McAlvany Wealth Management, what they do?
Yeah, I think from a different perspective, we focus on asset management with an emphasis on hard assets. So hard assets are broadly defined by us as real estate, as infrastructure, as global natural resources, and as precious metals. This is not the physical precious metals. These would be your mining companies. So these are the four areas where we focus. And again, the focus is on hard assets. We want well-supported dividends. We focus on income generation as a part of a total return equation, low turnover, and focus a lot on the culture of the business that we're investing in. The quality of the assets is very important, but being able to really cultivate those assets and grow them is very different because, you look at corporate culture today, and frankly, you're rewarded for taking care of yourself. So the C-suite, when you're investing in publicly traded companies, we're really interested in who's at the top, who's in the middle, how they execute on a plan, how they take care of their investors. And so a lot of our due diligence is beyond the financial aspects of the company to are these people that we have confidence in. So hard assets is kind of our claim to fame. Doug Noland is a part of the team. Lila Murphy is a part of the team. And so we worry from the top down and invest from the bottom up. And that brings in sort of the macroeconomic overlay, but with fundamental, minutia, if you will, or micro analysis at the company specific level.
Yeah, I believe Doug Nolan and Lila were both with Prudent Bear in the past, Prudent Bear Fund, and David Tice, who I know very well. They both did both of them work for Prudent Bear at some time in the past? Lila and Doug?
They worked with Tice. That's right. Lila has 25 years. She worked with two of the hedge funds that David Tice had, and then one of the natural resource mutual funds before all of that was sold to Federated in 2008. So we have a very dynamic team that is very engaged, again, with the combination of macro and micro, and Doug's just a very capable guy, super smart. And if you haven't read his Credit Bubble Bulletin, it's on our website, mwealthm.com, every week. He still writes the Credit Bubble Bulletin. He's been doing that for 20-plus years.
Yeah, and you also do an excellent podcast every week, too, I should tell people. Where can they get that? McAlvanyCommentary.com. You can find it on iTunes or anywhere podcasts are, but this is, I think we've done close to 620 episodes. That's 11 years and counting. And they're excellent.
We're helping somebody.
Yeah, they're excellent, and you really boil down a lot of information from the past week. And it's very helpful. I listen to it as often as I can. Last week when you were in New York, in your presentation that I listened to, your PowerPoint presentation, you showed a group of Chinese and American investors. The title of your presentation was "Shelter from the Coming Financial Storm." Although 2008, 2009 was indeed a financial storm, if not a hurricane, I would suggest closer to a hurricane. On the surface, things seem to have calmed down, and Trump administration, of course, they're crowing about how great the economy is. So, I mean, I suspect that a lot of people are basically saying, well, what are you worried about, Taylor? Look at the stock market. It's still hanging up there. It even made a new high the other day. So why do you think that we're facing a financial storm, David? Just perhaps summarize why you think why we're in trouble.
Sure. Well, a couple of things. One, certainly when things can't possibly get better than they are, maybe that is a turning point within the markets. And, so we're at 50-year lows on unemployment. GDP growth is not that bad. On the other hand, we see inflation in terms of a recovery cycle. This is the lowest inflation we've ever seen in a recovery cycle, 2.4%. And, we're just not seeing what we'd normally see in this environment. Now, I mean, you and I have had conversations about debt on this program and others, and obviously the total quantity of debt is a big deal. Corporate debt has grown, governmental debt has grown, but I think one of the things that we should also focus on is the earnings of the companies that support that corporate debt and the size of GDP and GDP growth relative to the growth in debt. And I think this is a really important clue for your listeners. Yep. If you look at debt to EBITDA, that is earnings before interest, tax, depreciation, and amortization, you always see that ratio shrink in a recovery because your earnings are improving and your debt's relatively static. And then in a recession, of course, you see the number expand pretty dramatically as your earnings shrink and your debt stays. It's kind of the burden that hangs out for a while. Well, different than any other cycle. Here we have debt to EBITDA spiking now, and we are not in a recession. What does that tell you? It tells you that in corporate America, it has loaded the boat with debt, and the concern of being able to service that in a soft patch of some sort, a soft landing of some sort, or God forbid a recession, it's going to get really ugly really fast. And corporate America already has this magical tell, debt to EBITDA, which is telling you it's bad now, and should we see a soft patch, it's going to go from bad to terribly worse.
I just have the feeling that the Fed is really trying to stay out in front of anything as terrible as 2008, 2009. You sort of referred to that in your discussion the other evening here in Queens about how you think that our Fed chairman sort of looked over the precipice and got scared, got the bejeebers scared out of him, and he all of a sudden turned the opposite way and started to provide what the screaming children on Wall Street were asking for, I guess.
Yep, Q4 2018. He was moving a very different direction. We were in a tightening cycle, and what you heard from him was a very different message than you heard from Yellen and Bernanke, and he was going to bring some discipline. And all of a sudden, that first week of January, he freaks out about something, walks in with prepared remarks, and says, "We're done. We're going to be lowering rates. We're going to be lowering rates multiple times." And it's a total 180, an about face from we're tightening and we're giving ourselves some latitude and we're going to normalize rates. Now all of a sudden we can't do that. And I think the reality is, Jay, we've got so much debt in the system. As you begin to raise the level of interest, that's where you see that debt is unsustainable. And so what they've tried to manage is the burden through manipulating interest rates. It's only been a few years that we've ever seen negative yielding bonds, but between 12 and 17 trillion dollars in negative yielding bonds, and I think that number grows through time because governments of the world are desperate to keep the game going. And if they are continuing to grow the total quantity of debt, the only way they can keep the wheels from coming off is by manipulating interest rates to lower levels to make the burden of debt from a cash flow standpoint actually affordable. We're going back to that, debt to EBITDA if you're talking about corporations, or debt relative to GDP. You can add $20 trillion more in U.S. Federal debt. You just have to keep interest rates at zero or move them negative.
Well, keep the game going is what they've been doing now with every cycle. It seems. Of course, we've had these these very severe downturns, and it really frightened the central bankers, I think. So it's not just a matter of keeping the game going, but I think it's trying to keep the whole system from imploding, David, from what I see, and what really stands out in my way of thinking is that with each credit cycle, the rates drop to new lows and new highs and new lows. And so it seems to me that, as you mentioned, debt to GDP, as debt grows, I like to say debt grows almost exponentially, and GDP grows in a linear fashion, if at all, and that doesn't work long term. So what did we get to on the 10-year? Did we get to 4%? We didn't get to, I don't know, somewhere around there was pretty much the limit, right? And then things started to break down. The equity market started to tank, and I think that it just scares them to death, and they have to keep printing money. So here's the thing there's a couple things that are different this cycle you mentioned. Another one is that they're starting stimulus at the top of the cycle, which never used to happen. The other thing is negative rates, David. So I'd like to ask you a little bit about your thoughts on negative rates. I saw somewhere that something like 94% of investment-grade bonds are denominated in U.S. dollars. So most of Europe has gone negative, Germany and most of the countries, I believe. And so the pension funds and people are having to get positive yield are sending money to the U.S. And buying treasuries. So, I mean, do you see any reason to think that rates are going to turn around and go higher? Could you perceive of anything like that?
Well, certainly not if it's being directed by the Federal Reserve, because the consequences are too grave. You have a totally leveraged financial system, and you can't allow the cost involved in that to move higher. It's game over. So, yes, the market can ultimately, jerk the reins from the Fed's hands, and, you could get a spike in interest rates. You could have your 1.5%, 2% jump to 4% pretty quickly. But again, that's a market reaction, and we're still in this phase where the Fed's trying to manage things. One of the things that's interesting in the last few years is as the quantity of bonds that have negative nominal yields has increased, the total quantity has increased, so has the price of gold. And I think really what that says, if you want to understand what a negative rate is, if you take $100 down to the bank, and the banker says, "I promise you, you will not get $100 back. I'm going to give you less. And no, I'm not going to pay interest, but I'm not going to give you all your money back." And with that kind of motivation, a depositor says, "Why don't I put my money in the mattress?" And that's what you see with an increase in the price of gold here in the last couple of years. Total quantity of negative yielding bonds continues to increase, and the money mattress syndrome is in effect, except people aren't moving, with $100 bills to the mattress. They're moving with a few ounces here and there. People don't remember how small the gold market is and how well contained supply and demand typically is when you're looking at industrial demand for gold and your central bank demand for gold. The swing vote is the investor, and it doesn't take very many investors to move the price of gold. It's very supply and elastic, and it's why you can see major moves because there's just not a lot of room for somebody to step in with $1 billion, $5 billion, $100 billion. Imagine 1% of the national net worth here in the United States. In June, it was calculated at $113 trillion as household net worth. Less than a 1% allocation to gold, $1 trillion. You'd say, well, that's not much of a move into gold. No, it's not, and you can't do it. Not unless you're talking about gold at $5,000, $6,000, $7,000, $10,000 an ounce. Yeah. It's too small a market. And so I think this is, again, where we're already seeing positive traction in the gold price as central bankers are playing with negative rates. What they don't understand is that they are playing with fire. They're playing with the market psychology. What does it mean to have a totally different relationship with your money, with your savings? Right. And they haven't experienced it yet. But I think they're gonna test the psychological realities of that.
All right, David, with just a couple of minutes left, we've had in my lifetime, in my adult lifetime, we've seen a couple of major moves, parabolic from $35 to $800, $850 for gold, and then from the low 200s to 1900 in 2011. Do you see something like that this cycle potentially? And if so, then the big question for today's show is, what should people be looking to do when we get to that point in time? And in your presentation, you had a wonderful the Dow to gold ratio, which I've seen many times. To me, that is perhaps the answer to the question, but I'll let you talk about it with a minute and a half left.
Yeah, the cycle is similar because people have not changed through time. It doesn't matter how much you change technology, you and I will still tend towards, in a part of the business cycle, to be incredibly greedy, be willing to take risk and put capital at risk. In another part of the cycle, be incredibly fearful, rein in and take risk off the table, move to cash, et cetera, et cetera. So what you see in the Dow Gold ratio going back to 1900 are these extreme swings from greed to fear. And, we are, clearly the most overblown stock market was in the year 2000. And, we are now at levels that were the equivalent of 1929. The stock market is raging, doing great. Gold, nobody really cares about it. It's not in the limelight for the investors. And when you look at that chart, what it gives you is a map for when you want to have a greater emphasis on paper assets and when you want to have a greater emphasis on hard assets. And the higher the number, the higher the ratio, the more attractive metals are. So right now it does make sense to be adding to a metals position, holding the metals that you have, and be very clear on what your exit strategy is. So you can take those metals and significantly increase your financial footprint by moving laterally into the world of financial assets or other tangible assets, assuming they're well priced.
Excellent. We'll have to leave it go at that, David. Thank you so much for being with us again. It's always a pleasure to have you, and I hope we can do it again sometime real soon.